How is everyone doing tonight? Welcome to the Strategy Room. You are here with the banker next door on this Saturday night, April 18th, 2026. So great to be back with all of you guys again this week. As usual, we have another jam-packed show. We're going to be talking about bank earnings. We're going to be talking about Trump threatening to fire Jeremy Powell yet again in round 25 of their dispute. Bunch of information on Kevin Warsh as he is looking to get nominated as the next Fed chair. We also have a lot of news on bank earnings for this week. As I mentioned, we're going to be talking a lot tonight about the AI discussion. Obviously, huge blow up that I reported last week with the White House. Scott Bessent, Jeremy Powell scrambling every major bank CEO to come in to talk about the potential threat from Anthropic's Mythos new AI system. Of course, has been a big conversation all week long. So I'm going to have a lot of news with that. We're going to continue the private credit conversation. We're going to be talking. They got a lot more interesting stuff there. As one of the big things that I talked about last week was with insurance companies. Have insurance companies been infected now with private credit? So we're going to take a look at a lot of going ons with that. I also have a lot of bank news. I have an M&A update. I also have a couple articles related to bank capital, some of the potential changes that are coming down the pike, and what is that? What could that mean for banks as we move forward? So, and of course, all the usual economic indicators and bank information and everything else under the sun I've got for you guys. Don't worry, I got you guys taken care of here this week. That's what we do here on Strategy Room. Okay, so with that being said, let's jump into everything here. So I always love to look at the U.S. debt clock. So we are now up to $39.1 trillion on the national debt. That equates to debt per citizen of $113,903, debt per taxpayer of $357,069. I'm sure you've got that, it's chump change, right? That's just lying around on the couch, right? U.S. federal budget spending up to $7.1 trillion, with the U.S. federal budget deficit at $1.678 trillion to the negative. Treasury reserve. This is kind of interesting. They changed things up here a little bit. Treasury reserve at $31 trillion. Refund per taxpayer at $83,309. That's kind of interesting. They took the tariff information off this week to put this USA Treasury Reserve information up here. So that's interesting there. The debt to GDP still hovering just a hair under 125%. Just not a very ugly number. Definitely not where we want to be. You'll notice this week, big number right here, kind of almost in the middle of the screen. Interest on the national debt finally went over $1 trillion. It was hovering very close to $1 trillion for the longest time. And now within the last week, we went over $1 trillion just to service the national debt. That is just for the privilege of having the national debt. We have to spend $1 trillion. So think about this. The U.S. federal budget spending right here is $7.1 trillion. So out of that $7.1 trillion, you had to spend $1 trillion just to service the 39.1 trillion in the U.S. national debt. Now, that didn't pay down a dime. That was just to service the debt. Think about that. Credit card debt still standing at $1.3 trillion with that is a debt per household of $8,270 per household. So, all right, so that's what we got here on that front. Let's take a look at, now I've got some articles here on the market. The market really rebounded very nicely this week. It was actually a very positive week. It's the third straight up week for the market. I have some numbers here, obviously Dow Jones, but I want to take a look at a couple articles here real quick. So the stock market recovery has been dramatic and fast, but the war is over until further notice. I don't know, maybe. Who knows? Market experts say the latest recovery for stocks, which now has indexes at new highs, has been more fast-paced than the bounce following last year's Liberation Day with the tariffs. So as far as the stock market is concerned, the war is over until further notice. Yardy's researcher Ed Yardeni said. Stocks are aloft and on the climb. So, and then let's take a look at this. S&P 500 hits record high as U.S. stocks recover from Iran war sell-off. The tech-heavy NASDAQ Composite Index is poised for the best 11th session performance in history. That's pretty amazing. That's pretty pretty amazing, right? The S&P 500 index rallied to a fresh record high on April 15th as U.S. stocks extended their rebound from last month's war-driven sell-off. The benchmark index jumped by almost 0.8% or 55 points to 7,022 at the market close. It has surged by more than 3% over the past week and is now up by 2.5% this year. Technology stocks also are rallying midweek with the NASDAQ Composite Index soaring by more than 376 points or 1.58% to 24,016. Then we go on to here. So the Iran war isn't over. So why are stocks back near record highs? So the Iran war isn't over, but stocks have rebounded from their war-driven sell-off, with the S&P 500 approaching a fresh record high on Tuesday amid optimism for a peace deal. Economic data has recently eased fears that higher oil prices would fuel a sustained acceleration of inflation and drag on consumer spending, the engine of the economy. So in the Middle East, not much has changed on the ground in the past week. Fighting continues in Lebanon. The Strait of Hormuz remains effectively closed, and negotiators left this weekend's peace talks empty-handed. On Wall Street, traders see things differently. The S&P 500 gained 1.2% on Tuesday, boosted by optimism for a lasting agreement between the U.S. and Iran that will end the war and reopen the Strait of Hormuz, the closure of which caused energy prices to skyrocket. Tuesday's gains put the benchmark index at a 2-month high and just 11 points or 0.2% away from its all-time closing high, which it did hit. So again, we're moving it forward, and then we go to Iran announces the Strait of Hormuz is fully open during Israeli-Lebanon ceasefire. Trump thanks Iran for the move, but said the U.S. naval blockade of Iranian shipping would remain in force until Tehran agrees to a deal. Now, again, I don't know what's going on. I saw some news earlier today that basically said that the strait was closed again, and Iran had bombed a couple of Indian ships or whatever. So I don't know who knows. It's just one week after the next. But again, at least this week they seem to make some positive development, some headway. At least seem to be coming down the pike this week. But who knows? I mean, this could all blow up and backfire at any moment. I mean, we don't know. Like I said, who knows? We keep going here. I think the positive thing was that stocks, were back up this week. And if we go back here for a second, so we can see here, the Dow Jones Industrial Average back up again, well over 49,000, back up to 49,447. The S&P 500 back to 7,126, and the S&P and the NASDAQ back up to 24,468. So again, the stock market really bouncing back here, really having a great week. It's basically had 3 really good weeks in a row now, which is always positive. So that is fantastic news. So, okay, now let's take a look on the interest rate front here. So, interest rate wise, so on the 10-year note, so 10-year note basically has come back down here to 4.251, which is great news. This is great. This is great. This is great that we've got this in here. We had hit up to, let's see here. Let's go back to the month here. We had basically gotten to a high of 4.438 on March 27th, right after, the war started, all the bombing started going again. We had gotten back up to a high of 4.438, but now we have steadily made our way back down to 4.251, which is great news. And as you guys will see here in a minute, that really had a positive effect on residential mortgage rates this week, as those rates really came back down. We'll talk about that in just a second, but I just want to go back to take a look at some of the other rates here. So we could see here, like the 2-year note, pretty much everything kind of went down at least a little bit this week. So the 2-year note went down to 3.712, 3-year notes 3.734, 5-year note at 3.841, 7-year note at just over 4%. Now, again, I had been pointing out that the really short-term bills, the 1-year T-bill, 6-month, 3-month, 1 month, they had all been trading in this really tight band, which was really interesting because you don't really see that level of tightness, and it's gotten even more tight, if you will, here over this last week. Is like you can see here, the 1-year T-bill is at basically 3.639. The 6 month is at 3.679. The 3 month is at 3.692. And then the 1 month is at 3.655. So you can see they're all at 3.6 and just trading in this very tight bandwidth, which is really kind of interesting to see at the moment. And we'll see if that continues to hold true over the next, say 5 or 6 months. But like I said, the good news though, like I said, is that you really saw Treasury yields and really come back down here over this last week. That was good news. And then, like I said, that led into the mortgage. So these are mortgage rates as of today. So mortgage rates have hit their lowest point in 5 weeks as the Middle East tensions begin to ebb. According to the Zillow Lender Marketplace, the current 30-year fixed rate is at 6.02%, down 13 basis points since last weekend. Meanwhile, the 15-year fixed rate is down 14 basis points from last weekend to 5.5%. So again, fantastic news. Certainly great news for anybody out there looking to buy a house, anybody looking to move during the spring selling season. Certainly great news for the residential real estate industry, for all the realtors out there. Hopefully you guys can buy and sell some houses, or at least get some houses sold. But again, the 30-year mortgage just a hair over 6% at 6.02. The 15-year fixed at 5.5. The 5/1 ARM at 6.17%. What else we got here? The 30-year VA mortgage down to 5.57% for all you veterans out there. That's great news. Now on the refinance front, 30-year fixed rate mortgage for, and again, this is for refinances, is at 6.12%. The 15-year fixed is at 5.57. 5/1 ARM is at 6.09, and the 30-year VA is at 5.48%. So again, rates coming back down where we really wanted them to be, and that was right at either 6% or a little bit below 6%. So we are right back. It's kind of amazing. I didn't think that they were going to bounce back this quick, but it's great. They bounced back very quickly, and hopefully, if we continue to have good news, fingers crossed here next few weeks. Hopefully this might even come back down into the high fives, 5.92, 5.90, may be a stretch 5.85, who knows, but it would be great if that could happen. But that will all depend on, if we get further lasting positive news here on the whole situation over in Iran, and if it continues to calm the market down. But again, just I think the important thing to note, great week for the market. Things really just bouncing back really nicely. Like I said, S&P 500 hits record high as U.S. stocks recover from Iran war sell-off, which is just fantastic. So we had a great week in the stock market. Treasury yields, interest rates, everything continued just to kind of calm down, come back down. So that was all great news. Like I said, the war in Iran appears to be going better, which is great. So again, all good news there. Now, I do want to share one thing here before we get into, as we start to get into some of the other things here. I'm going to get to bank earnings here in just a second, but the IMF cuts global outlook, warns Iran war could push global economy to the brink. So energy disruptions related to the Middle East conflict risk a recession-like slowdown and elevated price pressures. Now, if everybody remembers from last week, what I did was I showed this really cool article that basically had some great graphs and charts on it showing where the oil flowed around the world and how the United States really doesn't depend all that much. I mean, we only get about 2% of our oil from Iran and only about 10% overall from the Gulf states. So we don't really have much dependence on it. However, China has a huge dependence on it. India has a huge dependence on it. A lot of A lot of Southeast Asia, a lot of the countries over there, everybody from Vietnam to Thailand to Cambodia to Laos, they all depend very heavily on the Gulf states to be able to get the oil, to get the oil through the Strait of Hormuz and get it out there. So this is why the IMF is basically saying they're cutting their growth outlook and basically saying, hey, if this continues and the amount of volume of oil tankers going through the strait continues to remain very low, this could be a big problem here. So now I think the next 2 weeks will be very telling. Does the ceasefire hold? Do we get some kind of even a draft of a peace treaty? What is peace, so to speak, begin to look like? Does a certain amount of volume continue to build through the strait? I think these are all things that everybody is keeping a close eye on, hoping for the best and hoping that this continues to run through here. But obviously, not surprising that the IMF would do this. I mean, I think they're just being cautious and saying, hey, we're cutting the outlook for right now, but hey, we'll keep an eye on it, see what happens. Just as anybody else, I think any other rational organization would do at this point. So, but all right. Hey, just a quick shout out, Kevin Hawthorne, coming to us from Lakeland, Florida. Good evening, Kevin. Thank you for hanging out with us tonight. So a little shout out there for you, my man. All right, now let's get into this. So the GAO, Government Accountability Office, basically put out this fraud report this week with showing just off the charts fraud that they have found. So 521 billion fraud landscape, like what to know. A federal watchdog estimated that the government lost anywhere between 233 billion and 521 billion annually to fraud. That's just it's just insane. That is insane. So the federal government lost up to $500 billion to fraud each year over a 5-year period, according to an April 15th report from the Government Accountability Office, also known as GAO. So that's enough to employ 1 million people for 7 years or purchase 1 million homes. Federally funded state-run programs are major targets, according to the April 15th testimony from Robert Westbrooks, former federal investigator general. Westbrook said problems can occur when states control the disbursement of federal funds because they can reduce accountability and incentives. So based on data from fiscal years 2018 through 2022, the federal watchdog estimated that the federal government lost between 233 billion and 521 billion annually to fraud. And here's what we know about the primary sources of the financial drain. So misuse of pandemic relief. What else we got here? 3-year fraud in pandemic relief, stolen benefits, another big one, stolen benefits, food stamps stolen between 2023 and March of 2025. You can see, obviously, California, big culprit here, Tennessee, a big culprit, Georgia, Ohio, New York. Let's see here, improper payments. Medicare, obviously a huge one, 54 billion here, and Medicaid followed very closely, no surprise, 31 billion. Protecting state funds, and so it's just crazy. The level of fraud here is off the charts, and I just wanted to show everybody. The actual GAO report here. So this is the actual report. You can find this on gao.gov. But let's just read this for just a second here. So all federal programs and operations are at risk of fraud, regardless of whether they provide financial or non-financial benefits or delivery takes place at the federal, state, or local level. Understanding the scope of the problem is critical to combating fraud. In 2024, GAO estimated total direct annual financial losses to the government from fraud at between 233 billion and 521 billion, based on fiscal year 2018 through 2022 data. The estimate captures losses that occur at the state, local, tribal, or other government level if those losses included a federal investigation, administrative, or related action. State agencies administer federal programs, making payment, eligibility, and other decisions. In fiscal year 2025, the federal government provided an estimated 1.2 trillion with a T, trillion, to state and local governments in federal grants. The programs vary in size, but some, such as Medicaid, involve millions of beneficiaries. Decentralized program delivery, such as through distributed payment and eligibility decisions, can heighten the risk of fraud. Gal has previously reported that federal and state program managers' efforts to manage fraud risks have been challenged by weak control environments, data and system limitations, and limited capacity to manage risks. For example, one state agency administering a federally funded program reported it is restricted by state and federal laws from sharing information with other programs in the state, such as information on individuals and their use of state services. This hindered the agency's ability to prevent and detect fraud within and across programs. Federal programs, including those administered at the state level, are inherently subject to fraud risks from various entities and individuals. So, and then it lists out here the types of organized fraud groups targeting government programs. So we have organized criminal enterprises, groups organized around a program. Minnesota, anyone? Opportunistically organized groups, clusters of individuals that collaborate to exploit program vulnerabilities. Fraud basically as a one-off gig. And then, like I said, going back to groups organized around a program, this is fraud as a side business, sometimes mixed with legitimate business. And then, of course, organized crime is just fraud as a business. So, but again, very fascinating report here. I'm not going to, dig into the whole thing here because I'm going to actually do a separate episode on this week that I'm going to really, because I really want to spend some time really digging into this report and really bringing out a lot more of the details within it, so to speak. But again, I mean, it's mind-boggling and insane. I mean, I think from a lot of the things that we all see in the news week in and week out, I mean, I think you almost get the feeling like there is fraud everywhere and fraud in everything, and it's just insane the explosion in fraud that we're seeing throughout just all types of government programs and services across the board right now is just something to behold. I mean, it's just crazy. And just the fact that the government is, I mean, again, you go back to the debt clock. This is why I talk about this thing. This is why I talk about the debt clock endlessly. So the federal budget deficit right now, we are to the negative $1.6 trillion, right? Well, guess what, everyone? Okay, if you cut 521 billion in fraud out of this, now it doesn't fix the problem, but that's like a third. That's like a third of your problem to the negative right there is just fraud. I mean, that's just and again, it really makes you wonder, like, why did we get rid of? I mean, Doge is still there. It's still there, but it's not doing what it was supposed to do. It's basically Doge got neutered. They kicked Elon out, and basically there was no one there to really push it, and it got completely pushed to the background. And has anything happened? Doge exposed all kinds of fraud. Has anything happened with that? Has anybody been charged? Anything? Nothing. Absolutely nothing. It's like, and then you got the Government Accountability Office. This is not like some crank. This is not somebody just posting some nonsense on the internet. This is the Government Accountability Office, GAO, telling you that there is a stupidly insane amount of fraud and going through all of these government programs. And it's just, it's wild. It is wild. So, all right. I get off my soapbox on that one because I got a lot more soapboxes to get on before we're done here tonight. So, all right, this was big news this week. Any of my traders out there, anybody that likes to trade. So the SEC approves a plan removing day trading limit for investors. So the U.S. Security and Exchange Commission gave the go-ahead for sweeping changes to a restriction on day trading activity by small investors on Tuesday in a move cheered by retail brokers. So the Financial Industry Regulatory Authority, Wall Street's self-regulatory watchdog, had proposed reworking the pattern day trading rule, which bans a trader from making more than 4 day trades in a 5-day period if their margin account has less than 25,000 in assets. So, and now the new margin standards, which require customers to have enough equity in their account to simply cover the risks they run at that particular moment, will apply to all investors rather than just small ones. So, public feedback overwhelmingly supported this plan, which includes the elimination of the $25,000 minimum equity requirements and definition of pattern day trader. SEC Assistant Secretary Sherry Haywood wrote in an order. Steve Quirk, who's the chief brokerage officer of Robinhood Markets, said in an email that FINRA's updates were a significant step forward in empowering retail investors. By eliminating antiquated barriers, this change better reflects the modern trading landscape and ensures everyone has the freedom to invest and participate in the markets on their own terms, Quirk said. Reforms to pattern day trading restrictions are long overdue, said Anthony Denier, group president of Weevil Corporation. Shares in Robinhood rose, of course, and that is that. But this is a big thing. So you had what was called the pattern day trading rule. And this basically prevented, any traders that were out there trading on margin. So if you didn't have X amount of money in your trading account, if you were, again, this is all predicated on if you were trading on margin. A lot of people are not that brave or or reckless or but if you are out there trading on margin, and you are a day trader. That's the other thing. It's not just trading on it's trading on margin and being a day trader. So it's the combination of those two things. There are many people out there that trade on margin that aren't day traders, and vice versa. There's a lot of day traders who aren't necessarily trading strictly on margin out there. But again, if you were on margin and you were day trading, basically you had this rule called the pattern day trading rule, which basically said that if you had less than 25,000 in assets or cash position in your margin account, that basically you couldn't trade more than that. You were kind of capped, and you were hamstrung. Now it's basically just saying that, hey, as long as you have the necessary equity in the account to cover whatever it is you're trading, that you're good. You're good to go. You're fine. So I think, and so that's good. I think this is a positive development. I would caution people, though, that trading on margin is very risky, and you really need to be pretty good at what you're doing. I mean, I would absolutely recommend that if you're a rookie trader or a novice trader, meaning if you haven't been trading for at least a few years, you're still a rookie, and please get as much training and education on trading stocks and trading different instruments. Like for example, like if you want to get into options, or if you want to trade forex, which is currency, if you want to get into any of that stuff, read some books, read some reports, watch some YouTube tutorials from different people, follow people that are really professionals in the trading game that do it year in and year out and been doing it for 30 years. That's where you're really going to get the best, training and education on how to really become a really good trader. And you definitely want to do that kind of stuff before you really start getting crazy by trading on margin and stuff like that. And I will also tell you that most day traders on average are not successful at it, because day trading is hard. It is hard. I would say, and again, I'm not. I have to put this disclosure out there. Like, I'm not a financial advisor. I'm not out here giving people financial advice or anything like that. I'm just trying to give people tips. I'm trying to give people hey, this happened. If you do this, might want to think about that. Okay, that's it. All right, that's it. Not definitely not giving. I would always refer people, hey, go if you want to start doing stuff like this. Go talk to a financial advisor. Go meet a stockbroker. Definitely go talk to those folks out there. And there's plenty of them out. There's plenty of them out there. Plenty of them on YouTube. So to be sure. So all right. Let's move on here. Okay, let's talk about bank earnings here for a few minutes. So 5 things that we learned from bank earnings. So what executives said about trading windfalls, gas prices, private credit, and economic risks. So we have, I'm just going to run through this real quick because I want to show everybody just a very quickly a string of articles on earnings this week. Not going to go through all the numbers. I just want to give everybody the gist. So just everybody has a feel for how banks performed in the first quarter of 2026. So number one, private credit isn't Jamie Dimon's biggest worry. Oh, gee, that's good. Number two, volatile markets have been very, very good for banks. Of course, they make a lot more trading in volatile markets. Number three, surging gas prices aren't derailing spending just yet. Number four, CEOs see a tantalizing number of deals on the horizon. It's good. Number five, banks aren't entirely happy with the new capital rules. And we will, like I said, I have a few articles addressing that we'll get to later in the show this evening. But okay, we're going to come back to this in just a second to go through a couple of these in a little bit more detail. But before we do that, let's run through these articles here. So how did all the big players do this last week? So BlackRock quarterly profit rises on active ETFs and performance fees. So BlackRock reported a rise in first quarter profit on Tuesday, reflecting strong flows into its exchange traded funds and a sharp increase in performance fees, sending its shares up 4.1% in early trading. So that's good for BlackRock. And then we go on to Bank of America. So Bank of America tops estimates as CEO Brian Moynihan says consumer banking is healthy. So Bank of America's earnings per share marked its highest in almost 2 decades. Equities trading contributed to the beat as the geopolitical environment roiled stock markets. Then we go to Citigroup. So Citigroup beats estimates boosted by gains in fixed income. So Citigroup reported its best quarterly revenue in a decade and a 56% year-over-year jump in earnings per share. CEO Jane Fraser said the bank is on track to deliver its target for return on tangible common equity this year and said it's entered into the final phase of divestitures. With its global footprint, Citigroup is perceived to be more impacted by the geopolitical environment than many of its peers. So Citigroup doing okay for the moment. JP Morgan tops estimates on Wall Street results. Diamond flags increasingly complex economic risks. So JP Morgan Chase's fixed income trading revenue climbed 21% during the first quarter on rising activity in commodities, credit, currencies, and emerging markets. The bank beat Wall Street expectations for revenue and earnings per share. JPM lowered its guidance for full year 2026 net interest income, a key driver of bank earnings, from the previous $104.5 billion to about $103 billion. So yeah, JP Morgan making a lot of money. that's for sure. Morgan Stanley tops estimates as trading revenue exceeds expectations by nearly $1 billion. So you're beginning to notice a theme here that everybody did great. Everybody topped expectations. I think the expectations for the most part were pretty conservative. So it wasn't necessarily super hard for them to beat the expectations, but they all beat expectations nonetheless. But they all did it primarily on trading revenue. Trading revenue was really good for everybody in the first quarter here. So, but Morgan Stanley beat top and bottom line estimates for the first quarter. The firm's trading operations generated almost $1 billion more in revenue than expected. Morgan Stanley, led by CEO Ted Pick, since 2024, appears to have capably navigated the tumult of the first quarter. Then we get into Goldman Sachs. So Goldman Sachs tops estimates on record equities trading. Wow, shocking. Goldman Sachs posted record equities trading revenue for the first quarter, helping propel the overall firm to its second highest quarterly revenue. Investment banking fees climbed 48% to $2.84 billion, about $340 million more than expected on a surge in advisory revenue from completed merger transactions. Still, the firm's fixed income operations saw revenue fall 10% to $4.01 billion, an annually large miss of $910 million versus the street account estimate. So funny they should mention that, because my next thing here is Goldman Sachs bond traders stumbled as Wall Street rivals thrived. A fire is being lit under them. I bet it is. So Goldman Sachs fixed income division disappointed as they were down. Revenue was down about 10%, or about $910 million. I'd imagine that at Goldman, a fire is being lit under the traders, managers, and risk overseers and FICC after such an underperformance. The prevailing theory is that Goldman was caught offsides on trades tied to interest rates in the first quarter, according to several market participants who asked for anonymity to speak candidly. So very, very interesting information there. Now, I could get into a very long conversation on Goldman and Morgan Stanley about what they're doing with some of their traders over there, because it is, they are getting, how do I want to say this, very technologically advanced over there. Like their traders are not just adept in basically trading philosophies and market know-how and with their Bloomberg terminals and all that. AI coding, AI algorithms, like this has all become part of the daily job and daily tasks of a lot of the traders there. So I just wonder if maybe some of that was at play too, just in the way that they do things now, the level of sophistication in which that they implement some of these trades that they put in. Like, I'm just spitballing here, just wondering a little bit about that, about maybe if some of the way that they are doing things now basically played into some of this, perhaps, maybe, who knows. We'll see. If there's an article about it in the Wall Street Journal in a few weeks, so we'll know I might have been on the right trail there. So, all right, but so that's your snapshot of bank earnings. Let's get back in here to some of the comments here for a second here. So private credit isn't Jamie Dimon's biggest worry. So Jamie Dimon said he doesn't think private credit itself poses a systemic risk given the relative size of the industry. I'm not particularly worried about it. Now, I did talk about that last week when I covered Jamie Dimon's annual letter to shareholders, where he talks about that. I also did an episode this week, which I'll talk about a little later. I did a whole episode covering Jamie Dimon's letter to shareholders, where I talked specifically about his comments on private credit. I think it's kind of ridiculous that he would say that it poses no systemic risk. It's a $1.8 trillion market. Okay. And in some respects, it might even be a little over $2 trillion. And so for him to sit there and make a comment that's saying that there's just no systemic risk to it and that he's not worried about it after his infamous cockroaches comment about a month and a half ago, that's pretty astounding that he would be, it's like wow, man, you either don't know or you're playing dumb. Like which is it? That is So we'll see on that one. So but Diamond said that he is more concerned about a broader credit cycle, or when defaults rise and investors pull back, and how that would filter through the whole system. I think it'll be worse than people expect, he said, adding that something with an unexpected industry always happens. It might be software, it might not. So let's it's almost like, wait a minute, like, hold up, wait a minute, something ain't right. Let's rewind that tape for a second there, shall we? And unpack this for just a minute. I think it'll be worse than people expect. Okay. He said, adding that something with an unexpected industry always happens. Maybe like private credit. It might be, wait for it. It might be software. I just, what have I been talking about for months and months and months? What have I specifically covered in the last few weeks here? Every week I'm talking about private credit. Every week I'm bringing everybody the latest and greatest on private credit. What is the thing that we've talked about over the last month? What is perhaps the number one industry in private credit that has been affected? It has been software. It has been software. Help me, please. Somebody help this man. Adding that something with an unexpected industry always happens, and it might be software. It might not. Like, I mean, seriously, dude, you're on the one hand, you're saying that you're not worried about any systemic risk in private credit. And then on the other hand, you're literally saying that I'm worried about the credit cycle and things could turn. Well, could it possibly be that a blow up in the private credit market is the signaling of the turning of the credit cycle. Could it be? I'm not Nostradamus here, but I'm just saying that when you begin to see something like private credit unravel, that's usually the spark of that begins the turning of the credit cycle. You know, wow. All right, so yeah, so he's more worried about the credit cycle, and he's worried about that unexpected industry thing that could always happen, like the private credit. That might be like a software industry that's tied into private credit, like, but it's not systemic, and he's not worried about it. It's like, what? What? Okay. Um, Goldman Sachs CEO David Solomon said investors and analysts were right to focus on the credit cycle, given how long it has been since a major economic downturn or recession, excluding the COVID-19 pandemic. Now, why is that though? Well, that is because we are in the all bailout all the time economy, perpetrated by the Federal Reserve. Just anytime there's trouble on the horizon, they are right there to pump money right into the economy, and the Wall Street knows it. People on Wall Street know it, and yeah, that's where we're at these days. So number two, volatile markets have been very, very good for banks. So trading desks on Wall Street have been huge moneymakers since President Trump's return to the White House. A flood of policy and geopolitical news has forced traders to scramble to reposition their portfolios. What did I say? What was the theme that came out of all the articles that I just showed you guys? Well, that is that trading. Banks were making a tremendous amount of money off of trading, and trading business was really good there in the first quarter. You can see here banks' quarterly trading revenue. Let's see here. Who is the, well, let's see here. A lot of different colors here, but we can see, who would this be at the bottom here? This would be Bank of America at the bottom here. But yeah, I mean, Bank of America trading volume, but you can see all basically the trading volume here in the first quarter was up quite nicely. I mean, you had like 45 billion in trading volume between all of the top six biggest banks. So yeah, trading was good. Surging gas prices aren't derailing spending just yet. So at Bank of America, customers were spending about 16% more on gas. But Alistair Borthwick, the bank's chief financial officer, said that hasn't altered the underlying strength of the consumer. He noted that gas typically accounts for somewhere between 3% to 5% of consumer spending. JP Morgan executives made similar remarks, noting that gas accounts for a relatively small portion of overall spending. Yeah, but you start, gas is over $4 a gallon in a lot of places. I mean, you certainly you start to get to $5 a gallon. Yeah, you're talking about big time danger zone there. $4, a little over $4. People can deal with that. They could kind of figure it out. Not the end of the world yet, but it's not making people happy. That's for sure. Especially not when gas, especially not when in a lot of places around the country, gas was down under $3 in a lot of states. So yeah, you go from I don't know, 287 to now like 417, something like that. Yeah, that's a big difference, man. So, all right, number four, CEOs see a tantalizing number of deals on the horizon. So, deal making activity continued its hot streak in the first quarter, and bankers are hungry for more. Goldman's Solomon said the bank's appetite for mergers and acquisitions hasn't changed much from its high level at the end of 2025, despite a spree of multi-billion-dollar deals getting over the line since then. Solomon said he doesn't expect M&A activity to slow unless there is a big downturn in the economy, but noted CEOs are closely watching the impact of higher energy prices. And then number five, banks aren't entirely happy with the new capital rules. So banks scored a big win with relaxed new rules on how much extra capital they have to hold as a buffer against losses. Not everyone thinks they will benefit. Bank of America, Citigroup, and Wells Fargo executives told analysts the rules will likely be a positive for them, allowing them to hold less capital. Those freed up resources can be put to work elsewhere, such as on share buybacks or acquisitions. JP Morgan broke from the pack. Jeremy Barnum, the bank's chief financial officer, said the bank had concerns with elements of what's been put forward and noted it expects that the rules would increase the amount of capital it has to hold. So again, very interesting. There's some comments. So again, like I said, we'll get into the whole capital discussion a little bit later on. I've got some articles to share with everybody on that. But okay, all right, so before we jump into our whole AI conversation, I wanted to share, I thought this was pretty incredible news this week. So the Trump accounts, everybody remembers I told everybody about these new Trump accounts were coming out. Basically, if you signed your kid up, if you had a kid that was I think just born or just born within the last year or two, you could basically sign them up, and the government would give you $1,000 of seed money to start. Well, this is turning out to be insanely popular, as the Trump accounts for kids now total 5 million. And 1.2 million are already cleared to get the $1,000 in seed money, said Scott Bessent. So about 5 million children have been signed up for Trump accounts, according to Treasury Secretary Scott Bessent. Some 1.2 million of those children are eligible for a $1,000 pilot program contribution from the Treasury Department, Bessent said at CNBC's Invest in America forum. The $1,000 Treasury seed money is available to children born between 2025 and 2028. Parents or guardians can elect to open Trump accounts for their kids via IRS Form 4547 with their 2025 tax return or online through trumpaccounts.gov. So that, I mean, man, what a start. Holy cow. I was thinking, I don't know, maybe a couple 100,000, or maybe a couple 100,000, maybe 500,000 people might jump on that. I did not see 5 million coming. I did not see that. But hey, good for them. Good on them. So, and I do have a good article on this. The Wall Street Journal actually put out a really good article with some very nice graphs, basically showing and explaining how you can really use this thing. You can really juice the returns in this thing, and basically just after 18, 20, 22 years, your kid could be sitting there with a very nice pile of money to basically get them rolling in life. So again, I mean, this is just a fantastic start for these Trump accounts. All right, now let's get into this AI conversation, because there's a lot to talk about here with this. So, all right, so first, just to set the stage, I just want to show this to everybody. So TSMC, their first quarter profit rises 58%, beats estimates as AI demand fuels record run. So TSMC is over in Taiwan. I had to think about that for a second. Over in Taiwan. And basically, they are one of the biggest, if not the biggest, chip maker in the world. And but what you need to understand about TSMC is that they might make about 40% of the world's chips might come out of Taiwan, but 90% of all of the most advanced chips come out of TSMC. That's why it's important to pay attention to TSMC, because they don't just make chips, they make the best of the best. All of the top-notch stuff comes from those guys over in Taiwan. If you understand that, you understand why China wants them back so badly. It's not because China thinks that they are they're a part of the country and they need to, they're our bro, we got to get our brothers back or whatever. No. It's because the TSMC, the biggest, baddest chip maker in the world, sits right in the middle of Taiwan. Okay, and if you control those guys, kind of got the world by the you-know-whats. Okay, that's really the game. That's the game right there. All right, so just like I said, just wanted to point that out, and then we come. Now I'm going to take you guys through a series of articles here on what has unfolded around the White House and AI over the last, probably 3 weeks here. So first up here, Trump appoints major tech leaders to White House council. The founders of Google and Meta were among those chosen for the president's Council of Advisors on Science and Technology. So President Donald Trump revealed on March 25th that Meta co-founder and CEO Mark Zuckerberg, Oracle co-founder Larry Ellison, and other major tech leaders will be on the President's Council of Advisors on Science and Technology. The council will look at how emerging technologies can help the American workforce during what the White House called the golden age of innovation. Other tech bosses selected for the council include Dell Technologies founder and CEO Michael Dell, Google co-founder Sergey Brin, Oracle CFO Safra Catz, Netscape co-founder Mark Andreessen, Okla co-founder and CEO Jacob DeWitt, Coinbase co-founder Fred Ehrsam, entrepreneur David Friedberg, NVIDIA CEO and co-founder Jensen Huang, Nobel Prize winner in physics John Martinez. And John Martinez is a fun follow on X, by the way. If anybody if you've not followed him on X, I highly recommend it. He puts out some pretty good stuff from time to time. Commonwealth Fusion Systems CEO Bob Mumgard and AMD CEO Lisa Su. So again, very interesting panel that has been put together there. Now you might notice there's one big name that was not in that panel. A certain gentleman named Elon Musk was not named in this. Okay, so now we go to David Sachs, and we had some very interesting articles on Mr. Sachs here at the end of March. So first up, we had David Sachs says his time as Trump's crypto and AI czar has ended. So Trump's AI and crypto czar David Sachs said his role as a special government employee had ended. Sachs said he will remain a part of the President's Council of Advisors on Science and Technology. Sachs has been a prominent figure in the Trump administration since the president began his second term. Okay. And now we go to this. Trump names David Sachs co-chair of Tech Advisory Council, expanding AI crypto role. So Sachs will remain his AI and crypto czar, will retain his AI and crypto czar duties while advising on a broader range of critical tech issues, a senior White House advisor says. So his time as basically the crypto AI czar ran out, but then he got appointed to this White House council. And so basically he just retained all of his duties and everything that he was doing anyway, and just continued to, is continuing to run forward with it. Now we get to the crux of the problem. At David Sachs' behest, the White House barrels forward on industry-friendly AI policy. Trump administration plans to emphasize AI's economic benefits ahead of the midterms, but some allies warn of political blowback. I wonder what could go wrong. If anybody was watching last week, as I know everybody was, right? Because this is the best show ever. So what I talked about last week was the fact I kind of went on my soapbox a little bit about how can you not have rails around AI? There has to be rails around this. You cannot this cannot be the Wild West. This cannot be every man for himself. This cannot be everybody just running around doing whatever they want. And I'm saying this because of about what I'm about to show you, because what I'm about to show you is going to unnerve you. It's going, and it unnerves me. But let's continue with this just a second. So at a recent gathering of tech executives and lawmakers, David Sachs pitched artificial intelligence as a driving force of the U.S. economy. Building data centers that run AI models is creating thousands of jobs, lifting wages for blue-collar workers, and boosting gross domestic product, said Sachs, the face of the Trump administration's AI strategy, addressing a proposal from Senator Bernie Sanders to ban new data centers that run AI models. Sachs told the audience at Hill and Valley Forum, just think about all the damage that would do to our economic growth. So Sachs is not wrong with that right this minute. So it is doing these things that he says. It is creating thousands of jobs at the moment. It is lifting wages for blue collar workers at the moment. It is boosting gross domestic product at the moment. What happens, pray tell, when they're done building all the data? Say for argument's sake, everything goes great and they build all these data centers and all this AI comes to fruition. That's all wonderful. Then what? Where are all these workers? What's the next big thing they're going to? Where are they going to then? I don't know. So this is like a sugar high. Okay, they got it. The administration got in They jumped on this AI train. And again, and I'm not arguing that AI is extremely important. We're in this AI race with China, and we need to win. I just do not like the way that they're going about this. I think that this has been incredibly reckless. And the AI stuff, let me tell you something. All these data centers, and I'm telling you this right now, all these data centers, all this stuff, this is all going to get shut down, okay? Because you are just now beginning to hear all of the horror stories. I was listening to this one story in Florida today. They built these data centers in Florida, and now everybody in the entire residential area, they're all on water restriction. They can't, it's like they can only take showers certain times of the day. They can only use X amount of water. They can't wash their cars. They can't water their lawns. They can't do it, and this is only a taste. And then over in Texas, you had another data center built where they dumped some white substance or something into the river, and now all like the water is like, it's just gross. They tested it and found all kinds of heavy metals and everything in there. So the whole the whole data center building thing is, I think this is going to get shut down, and it'll get shut down in a couple of ways. The number one thing is that these companies cannot deliver. They do not have the money to deliver on this. They do not have the money to build. Look at Oracle. Look at Oracle's financials. Look at the projections that they have out there. They are insane. They cannot make this. They cannot deliver on these projections. They cannot do it. They have to get so much money, and they're all like, they've got so much money from the bond market, from the stock market, but a lot of them, they're turning toward private credit. They're turning toward all these crazy avenues to try to find any dollars they can to build these data centers. And the AI is not delivering fast. Like, it's not keeping pace with what they need. They've got to remember, all these guys are salesmen. They've got to sell you on this idea that AI is going to change the world. It's going to make your life better than it is today. They have to sell you on this, because if they don't, then you're not going to invest the money for them to build the data centers to deliver the AI. So they have to keep this sales pitch going. Now, they have gotten into the White House, and they got David Sachs in there as their main cheerleader. And David Sachs is like, this is our main growth engine right now, is the AI, and we cannot slow this down. Like, we have to let this thing proceed unabated at any cost and move right ahead. Now, I will remind everyone at this point, what is Silicon Valley, right? What's their motto? Move fast. Wait for it. Move fast and break things. That is their motto. Move fast and break things. Okay. They want to be disruptors. They want to go in, they want to disrupt everything. And as long as they're first, okay, they really depend on what's called first mover advantage. Okay. As long as you're first, if you blow up everything around you, but you're still standing at the end, you're going to be the winner, and you're going to, you're the winner take all. It's winner take all, basically. And that's their modus operandi. That's how they operate. And that doesn't work for America. That doesn't work for the country. Okay. You can't move fast and break. You can't move fast and break the country. Like, that doesn't work. That doesn't work for anybody. So all I'm saying is, I get that AI is important. I get that there are a lot of potentially great things that AI can do. I happen to think there's a lot of potential negative to the things that AI can do. And that's why I think you have to have guardrails around this stuff. So, but anyway, let's keep going here for a minute, right? So now here it is. You ready? White House races to head off threats from powerful AI tools. Wow. Really? Really? Nobody could have seen this coming, right? Nobody could have seen this coming. Let's recklessly run after this. Let's allow the tech bros to just run wild and do whatever they want to do, okay? And give them whatever amount of money. And whoever comes out first, winner take all here. Who cares? Let them have at it, because hey, our economy is, our economy. We got this growth from AI at the moment, right? Yeah, this is absurd. So the White House is now racing to head off threats from powerful AI tools. Group led by the National Cyber Director Sean Cairncross aims to identify security vulnerabilities before models from Anthropic and OpenAI are released. Okay, well, wait a minute here. This is the government. This is the federal government. Why? I'm just asking the question. This would seem to me like a national security issue. It would seem to me like the government could order these companies to basically say, no, you guys aren't going to release this stuff. And we're making this a matter of national security. You are not allowed to release this stuff, period. Okay, period. End of story. Don't care about your shareholders. Don't care about your quarterly revenue. Don't care. Don't care. This stuff has the ability to wreck. I mean, they did not call an emergency meeting. Scott Besson and Jeremy Powell, who just so everybody understands, can't stand each other. They did not call an emergency meeting last week to tell all these guys sweet nothings. They called them in because they said this could potentially wreck your banks. That's why they called them in. And and it was an what moment. So, all right, so let's go down here for a second. So, top White House officials are racing to address potential cybersecurity threats posed by the latest artificial intelligence models, highlighting how AI's perils are becoming a top priority for the Trump administration. National Cyber Director Sean Cairncross is leading the administration's response, convening officials across agencies to identify security weaknesses in critical infrastructure and bolster government systems that could be exploited by AI. People familiar with the matter said the administration is working with the private sector to make sure Americans are safe when new models are released. In recent days, the administration has held discussions featuring Vice President J.D. Vance and Treasury Secretary Scott Besson with leading tech and financial executives about coordinating the private sector's response to potential cyber attacks and preparing online systems, the people said. The move comes during an intensifying race among the top AI companies to release more powerful models that could cause widespread online disruptions if put to work by bad actors. Anthropic said this week its new AI model Mythos was so good at finding and exploiting software bugs that the company has no plans to release it to the general public. Instead, Anthropic has made a preview version of the model available to roughly 50 companies and organizations that run critical infrastructure, including leading tech companies such as Apple, Amazon.com, and Google. The aim is to find and fix bugs in hardware and software before the model is publicly released. The company has also held discussions with government officials about the model's cyber capabilities. Now, in addition, OpenAI and other model developers are also expected to release powerful tools in the weeks ahead. So I ask this to everybody. What happened with Anthropic? Well, funny you should ask. So Anthropic just got basically blackballed by the Department of Defense because Anthropic ran in and basically created all these new AI systems for the Pentagon. And the Pentagon wanted to use them in a certain way, probably in a way that they certainly didn't want them to be used. And Anthropic said no. And the Pentagon said, that's fine. You're blackballed. Get out. And then OpenAI came running right in to fill the void. So is it possible? I'm just asking the question. Is it possible that maybe OpenAI, who just lost in court, by the way, is it possible that Anthropic was just a little perturbed about the fact that they just got kicked out of the Pentagon and blackballed, and maybe it's not a coincidence that they decided to say, hey, oh, by the way, we've got this little thing called Mythos over here, and we're going to release that, and that's going to wreck the economy. Yeah, it's like, yeah. Wow, okay. I don't believe in coincidence, folks. I do not believe in coincidence. But it's just wild that this is out there, and these guys are basically like, yeah, we don't see any problem in releasing this. We don't see any problem in releasing this. Yeah, it's gonna find the bugs and everything, and then the hackers will be able to exploit that to no end. Yeah, yeah, sounds good to me. What in the world? All right, and then some other things here. So Jamie Dimon says Anthropic's Mythos reveals a lot more vulnerabilities for cyber attacks. So Jamie Dimon said AI is a double-edged sword. It's made it worse. It's made it harder, creating new cyber vulnerabilities, even as it may eventually strengthen defenses. So J.P. Morgan Chase is testing Mythos AI model from Anthropic, which Dimon said shows a lot more vulnerabilities need to be fixed. Despite heavy investment in cybersecurity, Dimon warned risks go beyond banks and include other financial parties, including exchanges, making cybersecurity a full-time job. So, yes. So, Dimon said that JP Morgan was testing Anthropic's latest model, the Mythos Preview, announced by the AI firm last week as part of its broader effort to reap the benefits of AI while protecting against bad actors wielding the same technology. When asked by a reporter about Mythos, Dimon seemed to refer to Anthropic's warning that the model had already found thousands of vulnerabilities in corporate software. I think you read exactly what it is, Dimon said. It shows a lot more vulnerabilities need to be fixed. The remarks reveal how artificial intelligence, a technology welcomed by corporations as a productivity boon, has also morphed into a serious threat by giving bad actors new ways to hack into technology systems. Last week, Treasury Secretary Scott Bessent summoned bank CEOs to a meeting to discuss the risks posed by Mythos. Yeah. So, again, if JP Morgan's on it, it's a problem. So, and then here, AI is finding bugs that hackers can exploit. Get ready for Bug-mageddon. So, White House and industry leaders race to fix vulnerabilities which AI models can discover with frightening speed. So, the software bug was capable of crashing an operating system used by firewalls, servers, and network appliances. It went undetected for over 27 years. Last month, it was caught by Mythos, the latest AI model from Anthropic that has spooked the White House, banking executives, and cybersecurity professionals around the world. Welcome to the bug Armageddon. AI models like Mythos and others are finding bugs in older software at a rate never seen before. While most of the coding issues may be minor, the sheer volume has amplified the risk that smaller software developers will become overwhelmed with reports of bugs such as the one Mythos found. Thanks to AI, hackers will be able to leverage those bugs more quickly than ever before. The 1998 bug in the OpenBSD operating system was one of thousands Mythos found last month. Anthropic said last week that it is working with about 50 technology companies and organizations to find and fix bugs and currently has no plans to release Mythos to the general public. We need to know that we can release it safely, and it's not exactly clear how we can do that with full confidence. So, I mean, here's the thing. Why do you have to release it? Why do you have to release this? Like, I don't understand this. I don't understand. Like I said, there has to be guardrails around this. Like, if this is not a clear indication, okay, if you have a technology that is capable of basically crippling the entire financial system, okay, this is a problem. This is a massive problem. What did they do after 9/11? After 9/11, they moved all the data centers out of New York City. It's in all the data centers they're in New Jersey, they're in Chicago, they're in Pennsylvania, Ohio. They moved all this stuff out, and they did that so that if there was ever another attack on New York, that it wouldn't cripple the financial system. We wouldn't have the stock market wouldn't be down for days or weeks. I look at this now. This is like the same thing. It's like what was the point of all these other protections if you're going to allow this to run wild and basically, negate everything else that you've done in the history of protecting markets? Like, it's insanity. Like, what? Like, why are you allowing? Why is the government? Why are you allowing this? Like, no, you need to come in and put guardrails around these guys, and you need to tell them straight up, like, no, we're not going to allow. Sorry, guys, we're not going to allow. You can't release it. Never. You're never going to be allowed to release this. I'd be calling OpenAI. I'd be calling everybody else and say, anybody, any one of you think about releasing this, okay, you're done. Okay, we are going to shut you down. Period. It's crazy. All right, let's see here. Let's keep going here. Now here's another one. So this was from yesterday. Trump says he had no idea Anthropic's Amoti met with White House about Mythos. So Anthropic CEO Dario Amoti met with White House Chief of Staff Susie Wiles to discuss the company's new Mythos AI model. Treasury Secretary Scott Bessent was also present, a source told CNBC. The White House said talks were productive and constructive, addressed innovation and safety, whatever that means. Whatever that means. President Donald Trump told reporters that he had no idea that Amoti was there. So Donald Trump's got no idea that Amoti is meeting with the chief of staff and with Scott Bessent to talk about how, this Mythos can wreck the financial system. That didn't make it to his desk, I guess. The White House said its meeting with Anthropic CEO Dario Amoti was productive and constructive on Friday, the latest sign of a potential thaw in the standoff between the government and the leading artificial intelligence company. But when President Donald Trump was asked about Amoti's visit on a runway in Phoenix, Arizona, he responded, "Who?" And then he said, "No idea." So Amoti met with Susie Wiles, the White House chief of staff, and other senior administration officials to talk about the company's powerful new Mythos model, which was announced earlier this month. We know all that. We discussed opportunities for collaboration as well as shared approaches and protocols to address the challenges associated with scaling this technology, the White House said in a statement on Friday. The conversation also explored the balance between advancing innovation and ensuring safety. Yeah, like guardrails, those things that you put in to make sure that things don't go off the road, right? Or off the rails, right? The company appears to be inching back into the White House's good graces weeks after Trump blacklisted it and called it a national security risk, declaring that his administration would not do business with them again. An Anthropic spokesperson said Amoti had a productive discussion with administration officials on Friday about how the company and the U.S. government can work together on key shared priorities such as cybersecurity, America's lead in the AI race, and AI safety. So again, I posed the question. I put it out there. Do you think it's that much of a stretch? Anthropic was getting blacklisted. Got booted out of the Pentagon. Do you really think that it's any stretch for them to basically come back and say, okay, you guys want to treat us like that? That's cool. Okay, we got something for you right here. It's called Mythos. Okay, yeah, go chomp on that. All right, and we'll see how quickly you guys come running back. Okay, and that is exactly what happened. And now they're working their way back into their good graces. Oh, shocking, right? Shocking. Can't imagine why. We basically, unless you let us back in the door here, we're going to wreck the entire financial system by releasing this AI model. But again, it just shows you this is what happens. This is what happens when you let the tech bros run wild. When you let them run wild and they've got nothing, no guardrails, nothing around them. This is what we can expect. This is what's going to happen. All right, and let's just take a look at a few more things here on the AI front here. So Gen Z Americans grow more skeptical and angry about AI, survey finds. So more than half of Gen Z respondents say they use generative AI regularly, but few say the technology makes them feel hopeful. So young Americans are using artificial intelligence regularly, but their distrust and resentment toward the technology are also growing, according to a new Gallup survey. The survey released on Thursday found that more than half of Generation Z respondents aged 14 to 29 said they use generative AI either daily or weekly. Young members of Gen Z who are still in K through 12 education are more likely than Gen Z adults to say they use AI at least weekly. Yet, even as usage remains widespread, optimism is fading. Compared with Gallup's survey last year, young people are less excited about the changes AI could bring and more skeptical about its growing presence. The share of respondents who said AI made them feel hopeful fell to 18%, down from 27% a year earlier. The share who said it made them feel excited dropped to 22% from 36%. At the same time, negative feelings have grown. 31% of respondents said AI made them feel angry, up 9 percentage points from 2025, and 42% said it made them feel anxious, roughly unchanged from last year. Yeah. So among employed members of Gen Z, skepticism was especially pronounced. Gallup found that 48% of working Gen Z respondents said the risks of AI in the workplace outweigh the benefits, an 11-point increase from the previous year. Only 15% said they viewed AI as a net positive on the job. Again, and then confidence in the technology's practical value also faltered. So again, the sentiment around, the only reason I point this out is because the sentiment around AI is beginning to shift a little bit here. And you're seeing that. And then also, let's see here. We're using up so much AI that computing firepower is running out. AI companies are rationing offerings and products, rankling users, a warning sign for a boom that depends on rapid adoption. So the artificial intelligence gold rush is rapidly drying up the supply of one resource that AI developers can't do without: computing power. The sharp capacity crunch has caused consternation among power users, forced companies to scuttle products, and led to reliability problems. The issues are a warning sign for the AI boom, as they may limit the utility of powerful new AI tools, just as massive amounts of users have begun to rely on them to boost productivity. Over the past few months, demand has exploded for agentic AI, autonomous tools that use the technology to independently perform tasks, from writing software code to scheduling house tours for real estate brokers. Companies have been scrambling to secure the availability of computing capacity needed to serve a growing base of customers who are also significantly increasing their AI usage. Everyone's talking about oil, but I think what the world is mainly short of is tokens. So, so basically, basically demand is growing far faster than companies are able to access resources and build out infrastructure. So yes, and this is what I talked about earlier. The AI thing, it's going to stop because of two things. Number one, they're not going to have the money, and the productivity gains, the promise of AI is not going to be able to keep up with the incessant demands and the need. And then when people with the damage, the collateral damage, if you will, from all these AI data centers on the economy, on people's electric and water bills, on just our natural resources. Okay, once that comes out, or once that begins to really take hold, people are going to say, no, forget this. This is all going to stop real quick. And people are going to say, right now, a lot of states are like, well, you can't outlaw data centers or whatever. Yeah, you watch. People start demanding the outlaw of data centers. Okay, what's the next thing politicians are going to run for office on? Oh, if you vote for me, I'm going to ban the data centers. Okay, and then they get in there and they will change the law to ban the data centers. That's what will happen. So anybody who's sitting there right now saying, oh, well, the law says they can't ban the data centers. You're right. They can't for right now. So I just, like I said, I just think that there are, I see a lot of problems with this. The most significant problem, again, to me right now is the White House, and led by led by this guy David Sachs. Okay, the White House, just their reckless abandonment of letting the tech bros do whatever they want to do. Okay, and just we got to let them just roll power ahead, and just, hey man, if they make something, if they make some AI and it just wrecks everything, oh hey, it's cool. That's cool. We'll deal with it later, or whatever. Like, it's crazy. Okay, now just a couple of other interesting things here. So, AI talk dominates S&P 500 earnings calls in early 2026. I don't think there's any big shock here with this, but discussion about artificial intelligence dominating earnings calls of S&P 500 companies held during the first calendar quarter of 2026 as recession fears and tariff concerns were muted. AI chatter was a dominant theme throughout the calls on earnings from the fourth quarter of 2025 as mentions of artificial intelligence soared to 6,355, a nearly 16% increase from the previous quarter, according to an analyst of S&P 500 Global Market Intelligence data. So you can see here just the comments on artificial intelligence. Some of the other things, obviously, interest rate were big, supply chain, fiscal policy. But the two biggest ones, interest rates and artificial intelligence, obviously very big. Let's see. Let's go to financials for a minute. Interest rates still a bigger one, but artificial intelligence, right behind. TMT, wow, massive increase in the mention of artificial intelligence. Consumer supply chain still dominant. Real estate interest rate still dominant. Energy interest rate still dominant. Let's see here. Materials supply chain interest rate still dominant. Healthcare, and then finally industrials. So, but basically, yeah, financials. You can see there major mentions of everybody. But I mean, I think that's to be expected. I mean, it's the hot button at the moment, right? Like it's what everybody's reading in on. Everybody's keying in on this as being this big efficiency and productivity. It's gonna change. It's gonna change the world. It's gonna change everything. Got to have it. And then I think this is the last thing I do on the AI front. So AI aims to level the playing field among small and large banks, FNB CEO. So AI could help tip the scales more in community and regional banks' favor as they compete with the nation's largest banks, according to FNB Corp's top executive. The Pittsburgh-based company maintained its full-year expense range of $1 billion to $1.02 billion, but said it expects to hit the high end of that range due to increased growth investments, including several AI-related projects. The company believes AI will help itself and other banks compete better with the largest players. Small banks have an incredible opportunity right now to build product that's unique. Chairman, President, and CEO Vincent Deli Jr. said during the company's first quarter earnings call, because of AI, because of the changes that are occurring from a tech perspective with cloud-based computing, the speed of computing, the ability to develop software, I think you're going to see some pretty interesting things come about. And I think it's changing the equation on scale, particularly relative to technology. So FNB is currently working on several AI projects, including a new tool that will evaluate customers' internal and external financial data and use AI to cross-sell FNB products. The bank hopes to launch this by year end. So again, so just some interesting comments there from FNB CEO on just AI and what he thinks ultimately it will do to help. But just to end the AI conversation here tonight, so I just want to say, I want to reiterate just what I have said here from the beginning, and that is that I just believe that there needs, I understand, I see the importance of AI. I see the potential benefits of it. I also see a lot of negative in it. And I just want to move forward with the necessary regulation and guardrails around AI. It's like, AI, I heard somebody speaking the other day about AI as if it was like nuclear energy, nuclear power, right? Like, what is some of the lessons that we learned about nuclear? Nuclear is a great energy source. It is a very cheap and productive energy source, but it can also be a very dangerous energy source if it's not regulated and watched after and protected in the right way. Well, I see AI in a very similar vein to that. It's a great thing, but it also needs to be managed and watched after and cared for. And if it's not handled very delicately, and what that means is that there may be times when, sorry, you need to slow things down. And I feel like, yeah, we've just hit one of the with the advent of Mythos and the potential for some other things to be released here in the coming weeks, yeah, we hit one of those moments. It's time to pump the brakes. It's time to pump the brakes. It's time to put some guardrails on. It's time to pump the brakes, and it's time to tell the tech bros, sorry guys, you're gonna have to take a pause for a second here. We're gonna have to take a step back for a second. Okay, we're gonna have to take a step back in order to take 2 steps forward. Okay, that's how this has got to be. So, all right. All right, so that's all I got on AI for tonight. So, all right, guys, we got a lot more to get to here. I'm kind of running behind here because I went on this AI tirade here. Oh yeah, I had this other thing that I had these couple other articles here on AI. Probably not going to get into all this stuff, but like this was just kind of crazy. This Allbirds company, they make shoes, and now all of a sudden they're like, oh yeah, we're an AI company. Like what? Like what? What? Like what? Like what? You know? And then all right, and then this is what I really wanted to get into here is obviously, getting back into the private credit conversation, and we'll get back into this in just a second. But first, I wanted to pivot because this is the time of the program. I generally like to give everybody the I like to give three things. I like to give everybody the economic indicators that are coming out this week. I like to talk about the episodes that I put out this week, and then I also like to give everybody some banking news for the week. So the first thing, what's up on the screen here for everybody to see. First thing we're going to do is I'm going to give everybody the economic indicators for this week. So on Tuesday, April 21st, we get ADP Employment Change Weekly retail sales. Retail control for March, pending home sales for March, Atlanta Fed GDP now for the first quarter, API weekly crude oil stock. On Wednesday, April 22nd, we get the 20-year bond auction. On Thursday, April 23rd, we get the initial jobless claims, continuing jobless claims, manufacturing PMI, services PMI, and then finally on Friday, April 24th, we get the Michigan consumer sentiment and the U.S. Baker Hughes oil rig count. So yeah, a lot of jobs data, some retail data, some GDP data coming out this week. So that will be great to look for, of course. So, all right, now some banking news here. So let's look at some stuff here. Mortgage rates dropped. We talked about that at the beginning of the show tonight. FinCEN, Financial Crimes Enforcement Network, said that it returned nearly $1 billion to fraud victims. So the Financial Crimes Enforcement Network said its efforts have helped return nearly $1 billion to fraud victims since 2015. Industrial production capacity utilization decreased in March. The FHFA enterprise mortgages results were mixed in January. So the Federal Housing Finance Agency reported that the 60-day delinquency rate for Fannie Mae and Freddie Mac decreased to 0.99 in January, while the serious delinquency rate rose to 0.59%. Foreclosure starts declined 10.3%, while third-party and foreclosure sales rose 9.7% during the month. So we'll keep an eye on that. That might prove some interesting stuff in the next few months. We'll see. Small business optimism dropped in March. Producer prices rise in March. I'll talk about that in a few minutes after the private credit talk. FDIC to host meeting on cross-border resolution planning. So the FDIC this week will host banking regulators from the United States and Europe to discuss the resolution regime for global systemically important banks. Mortgage applications increased this week, obviously with the rate drop. No surprise there. New York Fed survey, business activity increases in April. Builders' confidence drops in April. Economic activity increases in recent weeks. So economic activity increased at a slight to modest pace in 2/3 of the Federal Reserve districts from early March through mid-April, according to the latest Beige Book of Regional Economic Conditions. Community bank case study competition begins. This is always good. I was like this. So the Conference of State Bank Supervisors announced that judging has begun for the 2026 Community Bank Case Study Competition. So CSBS said 35 teams from 28 colleges and universities have entered to compete for scholarships and academic recognition. Each team partners with a community bank to examine its approach to interest rate risk, lending decisions, and response to inflation since 2020. Teams will also analyze how banks manage and maintain adequate capital through various strategies. So I love it. That is good stuff. So I will obviously, when they get a winner, I will report on that and who the winning college was and the winning team and all that. But yeah, love to follow that. FDIC issues fourth quarter state profiles. I have an episode covering that this week. Always love to cover those reports. They're just great reports to have out there. Consumer sentiment was down nearly 11% in early April. Factory orders were flat in February. Consumer prices rise on energy. KC Fed said that the growth in farm lending activity continues. So large operating and livestock loans continue to drive strong growth in farm lending activities at commercial banks in the first quarter of 2026. Existing home sales decreased in March. ICBA supports changes to rule governing the conversion of credit unions to mutual banks. So ICBA said it supports amendments to a proposed rule governing the conversion of insured credit unions to mutual savings banks, but further reforms remain necessary. So, okay, we'll see what happens with that. The House is set to mark up ICBA-supported bill to reform the 1071 requirements. So the House Financial Services Committee next week will mark up ICBA-supported legislation to reform the Consumer Financial Protection Bureau's 1071 rule, according to media reports. The Small Lender Act would ensure that the vast majority of community banks are exempt from the burdensome reporting requirements. So we'll keep an eye on that this week coming up. Regulators to host forum next month on bank capital proposals. So the FDIC, the Federal Reserve, and the OCC will host an Ask the Regulators event next month to discuss recent proposals to revise bank capital requirements. So that should be pretty interesting. That is going to happen on Tuesday, May 5th. So, all right, we'll see what happens with that. ICBA ensures community bank perspective and is representative in AI security discussions. So amid ongoing developments regarding artificial intelligence and cybersecurity, ICBA is working with relevant vendors and organizations to ensure community banker perspectives are considered. Okay, see where that goes. Federal Home Loan Bank Des Moines to accept digital notes as collateral. What? The Federal Home Loan Bank of Des Moines announced it will accept digital notes as collateral for select loan types. So a digital note is a debt obligation evidenced by electronic records, executed using electronic signatures and stored with a digital custodian. It is not a transferable record under the Federal E-Sign Act or the Uniform Electronic Transactions Act. So very interesting. So we'll keep an eye on that one and see how that unfolds. Treasury IRS proposed rules on remittance transfer tax. So the Treasury Department and IRS issued proposed regulations that would provide rules and definitions related to a new excise tax imposed on certain remittance transfers. Okay. ICBA groups urge SEC to rescind cyber incident rules. So ICBA and other groups called on the Securities and Exchange Commission to rescind its cybersecurity risk management governance and incident disclosure requirements. So, all right, we'll keep an eye on that. And then finally, administration releases withheld CDFI funds. So the Trump administration has begun releasing 2025 funds for the Community Development Financial Institutions Fund that had been held up since it was appropriated by Congress. So, okay, there you have it on the bank front. So now, okay, one thing I wanted to share with everybody. So, maybe I should. Oh no, I already did it. So, all right. So I did an episode 2 weeks ago where I talked about reports that had come out from Gao and from the Office of the Inspector General, the OIG. And these reports were related to the SEC and the FDIC and the workforce reduction. So basically they were concerned about the number of employees that had left the SEC and the FDIC, and basically, how was that going to affect those organizations overall moving forward. Now, again, most of the vast majority of the people that have left so far were people that just took early retirement and left. These were not people that were like outright fired. But basically, it was understood that, hey, look, we're offering you a generous retirement package. You can take that and roll off into the sunset, or at a certain point you'll get canned. But they took retirement packages and left. So okay, so now, this is from Emily McCormick over at Bank Director. She had this little blog post here this week, but she basically said the Trump administration wants to slash more than $700 million from the Cybersecurity and Infrastructure Security Agency, CISA. And some worry this could leave community banks with fewer resources to fight bad actors. The proposed 26% cut comes on the heels of $135 million in spending reductions approved by Congress last year, bringing CISA's budget to $2.7 billion, according to the budget proposal. The White House wants to eliminate alleged inefficiencies and censorship and return the agency to its core mission of enhancing the security and resilience of critical infrastructure. So, I have no problem with that, but banks are part of that critical infrastructure, but running a leaner CISA could prove damaging. CISA provides information to groups such as the Financial Services Information Sharing and Analysis Center, a member organization that financial firms use for threat intelligence, said Steve Saunders, Chief Risk Officer at the technology provider CSI. Last year, CISA cut funding to the nonprofit Center for Internet Security. A number of community banks rely on the center's control framework, he said. CISA also plays an important role in coordinating federal response when a major cyber incident occurs. If the cuts are approved by Congress, they would come as the ongoing conflict in Iran has elevated potential threats. Let's suppose that Iran or a hacking group associated with Iran launched a large-scale attack on banks all across the country, says Saunders. Who's going to coordinate that response? Good question. Sanders hopes banks will call their congressional representatives, but bank leaders should know what they'll do to protect their institutions by reviewing their options for threat intelligence. Okay, but again, this gets kind of back to the heart of what I've talked about before. CISA, they got a budget of $2.7 billion. Like, that's not a tiny budget. Like, what? I mean, what? And the White House just wants them to get back to focusing on, enhancing the security and resilience of critical infrastructure, right? Like, that's their job. That's what they do. Like, so what, get away from other stuff that you weren't supposed to be doing or wasn't part of your core mission, and just get back to the core mission. And by the way, you're still going to have a budget of, $2.7 billion, okay. I don't see, and it's kind of like the same thing with the FDIC and the SEC. These guys have multi-billion dollar budgets. Like, I don't get it. You have thousands of employees and multi-billion dollar budgets, and you're still like, oh, we can't cut this, can't cut that. Like, every single one of them. I'm just like, look, if the White House came out and said, we're going to cut this thing in half, or we're going to cut it to the bone, like we're going to cut the budget from 2.7 billion down to like $500 million, and we're getting rid of 80% of the employees. Okay. If they were doing that, then I would be like, oh, wait, time out, hold up a minute. Like, this is kind of gotten off the rails here a little bit. What's going on here? Right. So, no, we can't, like, that's like not the, I don't think that's just like the worst thing in the world. I just don't. So, all right. Let's get back to now. What were the episodes? So I had 6 episodes come out this week. I kind of did things a little bit in reverse. Usually I put bonus episodes out on Sunday, but I didn't do that. I actually put it out on Saturday this morning today. But the 5 episodes this week. So the first episode I did was on Monday, and it was called "Do You Suffer from the Sunk Cost Fallacy?" So the sunk cost fallacy is a mindset of continuing onward with an investment or project based on past information, even though logic dictates that the outcome will not be favorable. Even when we are faced with flawed reasoning, human nature will not allow us to change course because of aversion to waste and the need to be right. The sunk cost fallacy can occur in both business and government. The sunk cost fallacy emanates from a sunk cost expense, which is a lost amount of money, time, or effect that cannot be regained. Economics tells us that the foundation of sunk cost fallacy is psychological and tied to several biases, which include loss aversion, commitment bias, and endowment effect. So again, I think the sunk cost fallacy is a really interesting phenomenon or behavior that happens with a lot. And you see it all the time. Like once you understand what it is, you will see it all the time and recognize that it happens every day in business and government. Every day it happens. That's why it was one of those things that may not be the most popular thing in the world to talk about, but it was a very important thing to talk about. Next on Tuesday, I did Remembering Frederick Bastiat. So Frederick Bastiat, he was a French provincial scholar. So as a young man, Bastiat was heavily influenced by Adam Smith and Benjamin Franklin. He developed profound beliefs in life, liberty, and property rights. His greatest work is a book simply called The Law, which was published just before his death in 1850. Now, Bastiat's grandfather passed away in 1825, leaving him the family estate. He became a gentleman farmer and part-time scholar. Over the next 20 years, Bastiat would write many articles, papers, and books. He also got involved in public life. In 1831, he was elected a Justice of the Peace, and in 1848, he was elected as a deputy to the National Assembly. He would serve until his death in 1850 of tuberculosis. So, and again, I did this episode because I wanted to cover his book called The Law, where the main concept in the book The Law is called legal plunder. It is an amazing concept that once you understand it, it's basically, it's one of those things that will change the way you look at a lot of things. And the law itself is a relatively short book. It's not a very long or detailed book, but it is basically become one of the main. It's kind of weird. It's called The Law, but it's generally thought of as mainly like an economics book. But it has a lot to do with the law and how basically the government does legal plunder in an economic fashion against their people. So again, it's a fascinating book. It is an all-time classic, and I wanted to cover that. But before I did that, I kind of wanted to do a piece on Frederick Bastiat just to talk a little bit about who he was and his life and let people learn a little bit about him. And I can actually show, hang on one second, if I can reach it. There we go. All right. This is, and let me pop out here for a second, just so everybody can see this. This is The Law. This is the book. It's called The Law. It is a total of 55 pages. 55 pages. Yeah, you could read this in, if you're a quick reader, probably about 2 hours. But it is a powerful book. It is a profound book. It is a book that it's one of those rare books that you read that, it will change the way you literally look at a lot of things. And once you understand the concept of legal plunder, you will see it. You will see legal plunder all over the government, all over it, even today. And this is why it remains a very popular book, because it's just as true today as when it was written almost 175 years ago. So again, I did that episode just to give some background on Frederick Bastiat, with the notion that I'm going to do an episode covering the book The Law. And like I said, and you can, I'll basically use those as kind of companion pieces, if you will, to each other. So, all right, now on Wednesday, I did a review of JP Morgan CEO Jamie Dimon's annual letter to shareholders. I talked about that a lot. I talked about that a lot in last week's live stream. And I wanted to do just an episode on that, just to delve into the details a little bit deeper. So I put that out on Wednesday. On Thursday, I did a review of Bank Director's 2026 risk survey. So Bank Director has released their 2026 risk survey. Key findings from the survey include regulatory risk recedes. Examiners are leaning on the are learning on the job, cybersecurity oversight, identifying cybersecurity gaps, credit risk concerns, and risk responsibilities. Banks are feeling better about being overburdened by bank regulators. They also feel like new bank examiners are inexperienced. Less than 50% of bank boards brought in an outside cybersecurity expert to learn from. 89% of banks did conduct a tabletop exercise of their cybersecurity incident response plan. Overall credit and commercial real estate were top concerns this year. 54% of banks surveyed employed a chief risk officer. So again, very great survey. Bank Director always does a phenomenal job with a lot of the surveys. They don't put out a ton of them, but they put out, I don't know, 4 or 5 main ones every year. And again, love looking at and reviewing their surveys. They always have some great information in there. And then on Friday, I did an update. I did episode 39 of the crypto series, which was called A Bitcoin Rebound, Strategy Losses, and Iran Crypto Economy. So in this episode, we examined Bitcoin's performance over the last month through a chart and multiple articles. Has Bitcoin found a new resistance level? Will it see continued increases? Has Satoshi Nakamoto been found? I don't know. Coinbase receives conditional approval from the OCC for a bank trust charter. Franklin Templeton acquires crypto firm 250 Digital to be included in their new Franklin crypto unit. PayPal, Conversa, and Neum are racing to incorporate stablecoins and cross-border plays. Strategy purchase an additional $1 billion in Bitcoin after posting a $14.5 billion unrealized loss in the first quarter of 2026. Iran's crypto economy has increased to approximately 7.8 billion as crypto and stablecoin have aided both their citizens and the regime. FDIC sets stablecoin standard for banks, while the White House Economic Council downplays stablecoin threat on bank deposits in a new report. So, and then finally, today I did a BND strategy room bonus, which was just a clip from last week's strategy room on private credit, basically saying, has private credit infected insurance companies? And I'll do that is a good segue back into our private credit conversation here. Let me just find out where we were here. Okay. All right, guys, let's get back into our conversation here because I still have a ton of stuff to cover here. All right, so why BlackRock is weathering the private credit storm better than their peers. So powered by its core index fund business, the world's largest asset manager is now also the most valuable one. So BlackRock went on an acquisition spree in the past few years to juice its growth in private markets, Wall Street's hottest area. But these days, with investors' faith in that sector shaken, it is BlackRock's steady, if less glamorous, public markets business that has the company on stronger footing than rivals. Every private asset giant has taken a hit in the markets to some degree, but BlackRock is outperforming peers. That explains why the world's biggest investment manager recently reclaimed a title it had ceded to one-time corporate cousin Blackstone for most of the past 5 years, Wall Street's most valuable publicly traded asset manager. Unlike other firms fully focused on alternative investments, BlackRock has a public fund business to backfall on, one that is taking in more than $500 billion of new money a year, and that has a record of growing through turbulent stretches in the market. So there you go. So BlackRock, again, obviously, because they're like the biggest mammoth in the world, so they're able to better. They've got other other business lines, other avenues, other things that they can fall back on. So they have been better able to weather the private credit storm here, if you were. So crazy math confronting everyday investors in private markets. So investors questioning private credit's numbers could do the same at private equity funds. So Investors in private credit funds keep heading for the exits, partly driven by worries that the underlying assets might be overvalued. While private equity funds haven't undergone a similar flight, their own valuation issues are comparable and often more extreme. Both types of investment vehicles are becoming increasingly available to individual investors as more funds register with regulators and disclose their books publicly. Many are structured much like mutual funds, but with far less liquidity and fewer chances for investors to pull out. The turbulence is most visible in private credit, where funds tend to lend to middle market companies. While these funds have long pitched themselves as stable alternatives to stocks and bonds, investors are now flooding many of them with requests to cash out their shares. And we've talked about Blue Owl, we've talked about KKR and Apollo and all these big players, Blackstone, that have got basically getting bludgeoned for what's called redemption requests here in the last month or so. Then we go into you're an idiot. Apollo CEO Mark Rowan has a word for any lenders that can't meet 5% private credit fund redemptions. That's interesting. Software stocks are on the rebound, but fears are still widespread that enterprise software market debt in private credit funds is highly concentrated and at risk of default. Wait a minute. Didn't I just talk about this with Jamie Dimon? Didn't I just talk about this with his comments that this was, he was concerned about software, but wasn't concerned about private credit? I could have thought maybe we talked about that earlier. Just, I don't know. Alternative assets giant Apollo Global Management has seen its stock sell off by more than 15% this year as a result, and it limited redemptions in private credit funds to 5%. So Apollo's CEO, Mark Rowan, reiterated his firm's view at CNBC's Invest in America Forum on Wednesday that 5% redemptions per quarter are standard, and added that any private lender that can't meet this request is an idiot. Okay, it's a little harsh, but alternative investments giant Apollo Global Management has seen its stock swoon this year as a result of fears in the private credit market. At CNBC's Invest in America Forum in Washington, D.C. on Wednesday, its billionaire CEO Mark Rowan offered the latest defense of its book of business and latest attempt to distance the firm from the riskiest edge of the private credit market. Apollo has faced scrutiny for its decision to limit quarterly redemptions in a private credit fund to 5%. Other firms in the space have relaxed their redemption limits, though 5% is a generally accepted standard in the industry. Apollo has also been vocal in saying that many software valuations, the sector at the center of the private credit default fears, as a result of the potential for rapid AI disruption, are wrong. At the CNBC event, Rowan had even harsher words for some of the Apollo's peers and investors in the private credit space as redemption requests have risen. We have a situation where investors do not actually know what they own. Maybe they should have known, he told CNBC's Sarah Eisen. If you discover 8 weeks ago that enterprise software was vulnerable to AI, you kind of weren't doing your job, Rowan said. This is knowable. Well, yeah, maybe to him, not to everyday people. Again, that is not I kind of disagree with his comments here. Let's see here. And then obviously his private credit fund has been bludgeoned with redemptions, but basically they've capped it at 5%. But again, he's holding the line and basically saying that anybody that can't hold the line is an idiot. Which is kind of wild to me that he would be saying that. Okay. But we'll see. We'll see how I think these comments are going to come back to haunt him here in the next few months. But it's all right. We'll see. We'll keep an eye on it. Now this is no surprise, right? This is no surprise here. Wall Street builds new tool to bet against private credit. So credit default swap index could help banks reduce exposure to private credit and let hedge funds profit from the turmoil. So, and then here, just a quick chart. You can see, MetLife, Blackstone, Apollo, Jefferies, Ares, like all these stocks getting bludgeoned this year, bludgeoned. But large banks, including JP Morgan Chase, are preparing to offer a new way for investors to bet against managers of private credit funds. The banks are working with S&P Global to launch an index of credit default swaps that would protect buyers against defaults by companies included in the index called CDX Financials. Credit funds managed by Apollo Global Management, Ares Management, and Blackstone will make up 12% of the index, which also includes insurers, regional banks, and credit card companies. The index would rise when the market sentiment on those firms turns negative. If it gains traction, the so-called Findex would give debt investors and traders a fast way to hedge or short what is now a more than $3 trillion industry. Private credit increasingly touches banks, insurance companies, and other parts of the financial system. Private credit has grown fast, and there's a lot of financial exposure arising in different ways. So there is a real demand for this product. Yeah, I bet there is. Yeah, I bet there is. And it's just wild, man, that they, again, this is kind of classic Wall Street, man. Classic Wall Street. They sell you the product, and then when the product goes bad, they sell you the product to short the product. Like it's just wild, man. All right, and then some other things here. So bank execs downplay private credit risks in first quarter 2026 earning calls. So executives at several large U.S. banks downplayed the risks of lending to private credit providers as they reported their first quarter earning results. Investor concerns surrounding loans to non-depository financial institutions, also known as NDFIs, and private credit in particular, have been one of several factors weighing on bank stocks in recent months. In response to these concerns, executives at several large U.S. banks emphasized their underwriting standards and provided investors with new details on their NDFI portfolios during quarterly earnings calls. PNC was on there. Let's see, obviously JP Morgan Chase, we heard about that, Wells Fargo and Company CFO, Citigroup CFO, but Citizens Financial Group CFO, but all basically saying, hey, it's not risky, it's a great business, and we're going to keep doing it. As an aside, we're going to have some conversations with the regulators on the uselessness of what they've defined as NDFIs. So it's all this continue to have this big downplay. Oh, hey, nothing to see here, folks, nothing to worry about. Everything's fine. It's all good. Okay. All right. Seen this song and dance before. KeyCorp says private credit turmoil is shifting the balance back to banks. So investors pulling money out of private credit funds is hurting their ability to lend and opening a window for banks to do more business. KeyCorp Chairman and President CEO Christopher Gorman said, we've seen a steady march down in terms of spreads for a long time because there's just been too much capacity in the market with respect to commercial loans, Gorman said during a conference call on the bank's first quarter results. Now, with private credit fund outflows, spreads are firming. If you have a bunch of redemption requests, the first thing you do is stop shoveling it out the front door, which I think will give the banks in some instances an opportunity to re-intermediate some of those activities. Gorman said. He added later, I think we may be, and I emphasize the word maybe, at an inflection point on that trend. So broadly, commercial lending remains highly competitive and macroeconomic clouds are holding back credit demand. I've talked about this at length, that a properly graded commercial loan can't return its cost of capital, Gorman said. Banks like KeyCorp seek to sell clients a broader set of services in areas such as payments and strategic advice. So again, very interesting comments there coming from the CEO of KeyCorp. And again, he's not wrong. He's not wrong. We may be facing an inflection point here. Maybe not quite just yet, but if it hasn't hit yet, it's coming. And I do agree with him. I do agree that if the private credit market really stumbles and really begins to have problems, that those opportunities will shift back to banks, and banks they'll get a bigger chunk of the market, bigger chunk of market share, and we'll be able to make a lot more money on this stuff. So which would be good for them. So, all right. Now, last week I talked about this. This was kind of the big thing last week. Insurers 1 trillion buildup in private credit is leaving regulators in the dust. So Treasury Department officials plan to meet with states about their market risk. So, and I asked the question, this gets back to the BND bonus episode that I put up today, and that is, has private credit infected insurance companies? With basically insurance regulators are concerned about the amount of money that major insurance companies have invested in the private credit market. In addition, insurance companies may have inflated the valuations of those investments. So where have we seen this before? Yes, 2007, 2008, anybody? And what did I say a couple weeks ago? I said that the whole private credit thing, it wasn't the same as '07 and '08, but I said it had the same vibes. It had the same vibes, just in terms of everything that was playing out. And once again, what we're seeing here potentially in the insurance industry here with this is, again, it is the exact same playbook as what happened in the real estate market in '07 and '08. And now we get this. Insurers take bigger risks than before '08, '09 crisis, report warns. Industry is significantly worse off as it invests in private credit. And we can see here the annual U.S. annuity sales have obviously jumped dramatically here in the last few years. 2025, it was up to $465 billion in annual annuity sales. I mean, pretty amazing. But most insurance companies got through the '08, '09 financial crisis all right. A ratings firm just warned that the industry might not get through the next one unscathed. AM Best published a report Friday that finds that the investment portfolios of insurers that sell annuities hold more risky debt than they did in 2007, the year before the worst downturn since the Great Depression. The ratings firm adds that annuity portfolios had a slightly smaller financial cushion in 2024, the most recent year for which data was available, than they did in 2007. Annuity portfolios also held more investments that had been sold by companies with which they share some affiliations, such as common corporate owner. We're significantly worse off, said Eric Miller, AM Best Senior Director. The chance of not being able to pay your claims is just higher. The study looked specifically at the reserves insurers set aside to make payments on annuities, the savings vehicles that promise guaranteed income in retirement. In its examination, AM Best compared the 2024 investment portfolios that back those annuities with a snapshot of a similar universe of portfolios in 2007. So here we have individual annuity and individual life right here. Individual annuity, 1.53 total reserves, 1.53 trillion in 2024. Individual life, 1.39 trillion in reserves as of 2025. So, but life and annuity insurers have snapped up some 1 trillion in private credit. 1 trillion. Let me say that again, $1 trillion in private credit investments that promise high returns for investors willing to be patient. The trend was driven in part by several private asset firms, including, wait for it, Apollo Global Management and KKR, which acquired insurance companies and moved significant amounts of private debt onto their balance sheets. The arrangement can be lucrative for insurers and the investing firms that draw fees for managing insurers' accounts, and can increase income for policyholders, but it carries risks if underlying loans go bad. A recent spat of problems in private credit, including some defaults and losses, have brought scrutiny to the sector, prompting individual investors in some funds to flee and dragging down stock prices for private fund owners and exposed banks. Annuity sales have doubled in the past decade. The Center for Retirement Research estimates that around 10% of older Americans now hold such policies. With that, the pool of money backing individual annuities has grown to nearly 1.6 trillion, surging ahead of the dollar amount backing individual life insurance policies. In the worst case scenario, when an insurer collapses, a guarantee fund supported by other insurers in its state helps to pay the claims, but those payments are capped, and policyholders can end up losing much of the money they were promised. Insurance companies and their portfolios are well protected against the additional risks that come with private credit. The National Association of Insurance Commissioners, a group made up of the top insurance regulators in each state, Each state said in a statement that regulators have closely monitored changing portfolios and have required insurers to maintain capital appropriate to their risk profile. That conclusion was backed by an October report from S&P Global Ratings. Private credit may bring some added liquidity and complexity risks, but according to S&P report, these risks are being handled responsibly. Okay. But again, this is the insurance industry's big wake-up call on risky assets wasn't in 2008. It came in the late 1980s and the early 1990s when crumbling junk bond portfolios led to losses. Yes, that is absolutely true. And and it's just wild. It's just wild to see this. I mean, you've got these private equity firms here again, like Apollo, like KKR, that basically buy up the insurance companies and then have the insurance companies buy private equity investments, and and then the investment firm, they're basically double dipping. Like they're getting commissions on the sales of the securities. They're getting money for managing the account for the insurance company's account. All this. Meanwhile, the insurance company that they own is pumping up the annuities, pumping up individual life insurance. It's just so they're just making money, all the way around, and it's all good as long as none of this stuff blows up. But of course, private equity, as we are learning, is a very risky bet with a lot of enough opacity in it that it's a problem. The underwriting opacity is a major problem. So, all right. And then let's go on here. So, is the private credit industry falling apart? That's a good sign. Many signs are pointing to serious trouble in the private credit markets. Among many others, JP Morgan Diamond has warned that private credit losses will be larger than expected. That's a serious statement concerning a critical financial segment, often valued in excess of 14 trillion globally. Well, no, I don't think it's not worth 4 to 15 trillion globally. Demand of depositors for redemptions, and then this talks about, again, great chart here on redemptions. You can see here the massive increase in redemptions in the fourth quarter and in the first quarter of 2026. But again, this article just calls into question private credit and basically says, hey, there seems to be some big problems there. And then finally, bank director finally gets to the party here. Could private credit be the source of the next crisis? A surge in lending to private credit and other non-banks could be a big risk to the financial system. Yes. So love these guys. Are a little bit late to the party. I've been talking about this for well over the last year, but okay, better late than never. And again, and this article just reiterates a lot of what the article here did. Hey, is private credit industry falling apart? What's going on? What's happening? And reporting on. And then again, this is why everybody should be watching my channel here, because I'm telling you guys about this stuff months before these guys get around to talking about it. I was telling you guys about the failures of Tricolor Holdings and First Brands and PrimaLend. I was telling you about all this stuff before these guys caught, and now these guys are just catching wind to it. Like, oh, hey, there might be a problem here. Yes, there is a problem. It's a big problem. So, all right, that is my talk on private credit. Let's get into the Fed here for a few minutes as we get a little closer to the close here this evening. So, Trump threatens to fire Jeremy Powell if the Fed chair doesn't leave office on his own. So again, Trump this week coming out with the threats. If Chair Jeremy Powell stays on as the Fed governor after his successor is confirmed, President Donald Trump said he'll have him removed from office. Trump said the investigation into the renovation at the Fed's headquarters must continue. So we'll see. I kind of reported on that a little bit last week. Judge Janine is basically running with that, and she's kind of having a hard time of it because she keeps getting basically blocked on the subpoenas and other things that have been basically put out by a grand jury. But again, Trump coming out hard here, basically saying that, like, yeah, Powell's got to go. I tell you, that'll be real interesting. Now, obviously, the key word there being when Kevin Warsh is nominated. The nomination being the big thing there. So okay. Now I got a series of articles here on Kevin Warsh. So Fed nominee Warsh clears a hurdle to the Senate hearing. So the Trump administration is trying to arrange a hearing for Kevin Warsh, its nominee to be the next chair of the Federal Reserve. Warsh has submitted his financial disclosures that are required before he can advance that hearing. People familiar with the matter said on Monday. The Senate Banking Committee has yet to formally schedule the hearing, which would take place next week. At the earliest, but I thought that they had scheduled a meeting for I thought that they had scheduled a meeting for May, maybe like May 5th or something like that. But we'll see. But anyway, so Warsh, he submitted all of his financials, but then a little bit of craziness ensued here. So Fed nominee Warsh filings detail vast wealth, far exceeding past chairs. So Federal Reserve Chair nominee Kevin Warsh is worth at least $135 million. According to newly released financial disclosure forms, he also detailed significant wealth held by his wife, Jane Lauder, an heir to the Estee Lauder fortune. Warsh pledged to divest some of his assets if confirmed by the Senate. The Senate Banking Committee will hold Warsh's confirmation hearing on April 20. Okay, so there you go. So they will hold his confirmation hearing on April 21st, which will be, what's that, Tuesday, I think? So what's that? Yeah, 19, 20. Yeah, so Tuesday. Yeah, so Tuesday the 21st, they're going to hold this meeting, and that should be a good one. Should be a good one, but obviously Kevin's worth some bucks. I mean, 135 million. Like, man. So Kevin, now here's an interesting one. Kevin Warsh wants to lead a scandal-ridden Fed. His wealth is a complication. I'm sorry, I have to laugh at this. Like, he wants to just listen to the headline here. This is CNBC, right? This is not me. This is CNBC writing this. Kevin Warsh wants to lead a scandal-ridden Fed. This is how they describe the Fed, as scandal-ridden. His wealth, though, is a complication. Not the scandals at the Fed that he's basically being brought in to resolve. No. It's his wealth that's a problem. So Kevin Warsh's financial disclosures this week listed holdings of at least $100 million in funds. Senator Elizabeth Warren, of course, a Democrat who opposes Warsh's nomination, of course, criticized Warsh's partial disclosure on Thursday. Financial disclosures have been a source of controversy under Fed Chairman Jeremy Powell, and how Warsh deals with his own wealth will help determine whether the central bank can turn the page. Now, here's my issue with Kevin Warsh's disclosure here. I think he needs to be fully transparent here about what these underlying assets that he has. Like he's got to, because again, he cannot afford to come in the fight that he's about to fight. They're going to get dirty. And if it leaks that like he's got investments in something he shouldn't be having money and things that he shouldn't be overseeing or things he should have money in, that's going to be a problem. That's going to be a big problem for him. So it's better that just get it out there now. Put it out there now. Get it out there now because they're gonna come after you, man. When you get in there, if you want to do some of the things that you want to do, you're gonna run into some problems. So, but Kevin Warsh's newly released financial disclosures shed light on the Federal Reserve Chair nominee's vast wealth, but also raised questions about parts of his holdings that aren't fully revealed in the paperwork. That could be a challenge for Warsh as he seeks to overcome a legacy of ethical scandals under the current chairman, Jeremy Powell. Now, I love this, man. Like I have talked about the Fed so much on this channel, and it just makes me laugh that I've talked about all these problems. And what happens? What happens? Okay, you go to criticize the Fed, and what happens? They come out, the shield of independence. Pull that shit. I need to get a shield. Like I need to get like a Captain America shield, but I need to paint the Federal Reserve eagle on it and write Shield of Independence. So that way I can, just pull that thing out anytime the Fed gets criticized. Shield of Independence. But even right here, I mean, they're admitting that, like, yeah, there's been a whole bunch of scandals, and yeah, there's been insider trading scandals, and Lisa Cook with her mortgage disclosures of her mortgage on her statements, and all kinds of other nonsense. It's just funny. This only comes out when they're trying to give Kevin Warsh a hard time, or trying to discredit Kevin Warsh. Then all of a sudden they want to talk about all the Fed's scandals and problems, but on a normal day, when they're not trying to bash somebody or hit the president's nominee. Okay, if that's not on the agenda, then you can't criticize Jeremy Powell or what's going on at the Fed. So it's wild to see this. Okay. Anyway, like I said, it's literally almost comical. It's literally almost comical to see this. All right, let's go on here. So, okay, so wholesale prices. Now, this plays in with some of the rest of the Fed conversation here, because I'm just going to show you guys just a couple other articles here real quick. But the wholesale prices, the PPI index, inflation index, rose 0.5% in March, but much less than expected despite the war impact. So the producer price index, a gauge of pipeline costs for final demand, goods, and services, increased a seasonally adjusted 0.5% for the month, well below the Dow Jones consensus estimate for 1.1%. Excluding food and energy, core PPI was up just 0.1% against the forecast for 0.5%. On an annual basis, the all items PPI accelerated 4%. The biggest 12-month gain since February of 2023, the core PPI posted a 3.8% annual gain. So obviously that annual gain, not good right there. That is not definitely what we want to see, but it was positive, at least for the month, because it wasn't as big of an increase as what what they thought was going to come down the pike because of the Iran conflict. So, okay. Everyone is feeling uncertainty about the Iran war, the Fed's Beige Book says. So the Federal Reserve's Beige Book report showed that people around the country are filled with uncertainty about the outcome of the Iran war. The uncertainty is complicating long-term planning for businesses, potentially delaying hiring and expansion plans. The fresh wave of uncertainty adds to that already created by tariffs last year. So no matter what your place in the economy, chances are you're contending with uncertainty about how the Iran war will end and when the energy crisis it sparked will subside. That's the takeaway from the Federal Reserve's Beige Book, a compilation of anecdotal observations from around the country published Wednesday. The report was filled with references to people being uncertain about the Iran war, when it will end for good, and what impact it will have on the economy. Yes, as are we all. So no big shocker there. Then we heard from a couple of Fed governors. So Fed Governor Waller says Iran war and labor market risks are keeping central banks on hold. So high inflation and a weak labor market would be very complicated for a policymaker. The central banker said in a speech in Alabama, "If I face this situation, I'll have to balance the risks to the two sides of the Fed's dual mandate to determine the appropriate path of policy. And that may mean maintaining the policy rate at the current target range if the risks to inflation outweigh those to the labor market." So that was Waller. And then we get New York Fed President Williams is worried that the war will slow growth and aggravate inflation. So New York Fed President John Williams expressed concern Thursday about the Iran war's impact on the economy, saying it already has shown signs of hiking prices and slowing growth. This has begun to play out already. So, okay. And then we have Cleveland Fed President Hammack expects interest rates to stay on hold for a good while. So Cleveland Fed President Beth Hammack said the central bank is weighing threats to both inflation and employment and should keep interest rates on hold as conditions evolve. I think there's risks that we might need to be more accommodative or more restrictive, depending on how the data comes out, the central bank official said in a CNBC interview. So yes. So again, so now basically, so the reason why I say all this, you've got these comments from these 3 Fed governors, is because they're basically telling you that, yeah, they're signaling to you that they have no desire to decrease interest rates anytime soon. That they're basically like, we're in a holding pattern right now. But they are dropping subtle hints, like here. Um, ba, 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 ba. So here, she says that we might need to be more accommodative or more restrictive, meaning rate hikes. Okay, where so again, like they're leaving their options open at the moment, but they're basically telling you that, yeah, there's not going to be any rate cuts coming anytime soon. That's what they're basically signaling to you there. So, all right, that is my Fed discussion, and I had all of these. Man, I had some. I wanted to go in here. I had an M&A update, and I had some articles and some capital stuff and everything I wanted to go over with you guys, but we just ran. We're just running a little too late tonight, so I'm just, what? I'll just have to save some of this stuff. I'll come back with some of this stuff again next week, and we'll get into a bunch of this as it were. So. All right, so with that being said, I am going to go into wrap-up mode here. So before I get to my story of the week and my quote of the week, I just want to go through a couple things. If you are listening on Apple Podcasts and Spotify, please make sure to leave me some reviews, because those reviews really, really help the podcast, really help the platform. So that would be fantastic if you could just leave some reviews in there. What else I got here? So make sure to visit thebankernextdoor.com. Check out the website. I have a lot of good stuff up there on the website. Make sure to subscribe on YouTube to get the latest via post. Like if you want to know when the strategy room is going to be, what we're going to be talking about, what episodes are coming out this week, I put all that stuff up in YouTube posts. So if you want the latest and greatest, make sure to subscribe to the YouTube channel. You can send comments to info@thebankernextdoor.com. Send comments, questions, topic recommendations, all that stuff. This is how you get in touch with me right there. info@thebankernextdoor.com. Make sure to follow me up on Getter, X, and Truth Social. I will tell you that I do spend the majority of my time on X, but you can follow me on any of those platforms. I'm posting stuff all week. BND, just remember, BND, we are on YouTube, Rumble, and all major podcast platforms. We have new episodes that come out every Monday through Friday, premiering at noon. And the BND Strategy Room live stream is every Saturday night at 8 o'clock here on YouTube. Coming soon to some other platforms. I know I keep saying that, but hopefully it'll happen. It'll happen. All right. So with that being said, let's get to hang on, let me just load it up here, get it ready. Okay. Story of the week. I thought this one was pretty good. So this is Global Strategic Petroleum Reserves. So also known as the GSPR. So the GSPR are stockpiles of crude oil maintained by nations and by private industries as a hedge against potential future energy crisis. The U.S. government has tapped its own strategic petroleum reserve after a number of disasters that threatened to disrupt the flow of oil to industry and consumers. The interconnected nature of the global oil market makes a disruption in any given area likely to affect prices across boundaries. Obviously, we've seen that, right? In the event of a major disruption due to political upheaval or natural disaster or wars or attacks, whatever, countries holding reserves could increase the available supply of oil by releasing some portion of the reserves. That replaces the lost supply and moderates any sudden price surges. So the theory goes. Unfortunately, what we've seen the last few times that the strategic petroleum reserves were tapped, they really didn't have the intended effect. It really didn't make much of a difference at all. So does that depend on the situation, the nature of the situation, some of the intricacies in and out? Perhaps. But again, I just wanted to bring that up there. The global strategic petroleum reserves, just an interesting thing, I think, to make note of, especially given the current situation. So in the U.S., our strategic petroleum reserves are very low. They have been since Joe Biden just basically released half of them a couple years ago, and President Trump was refilling them, but then the issue here in Iran, and then they just did another release, so we're kind of back down a little bit again. So I don't know. Hopefully, this thing with Iran will get resolved, and they'll be able to get the reserves refilled. So hopefully, before another thing hits, right? So all right, and then finally, our quote of the week here. So this comes from Virgil in the Aeneid with what's his name, getting ready to release the Odyssey, the great director Christopher Nolan. Christopher Nolan getting ready to release the Odyssey this summer. I'm very excited for that. So this comes from Virgil in the Aeneid, and this goes, endure the hardships of your present state, live and reserve yourselves for better fate. So in other words, basically endure the hardships, because you need to, get through what you're dealing with, because you need to reserve yourself for better things at the end of the day. But a great quote from the character Virgil in the Aeneid. If you've never read the Aeneid or the Odyssey or the Iliad, these are all and fantastic, amazing books to read. Learn all about Achilles and the Trojan War and everything else. Or you could just watch the movie Troy. It's kind of, anyway, all right. Last thing for the night, I'm actually getting Stonier Week is coming up upon us soon. The ABA Stonier Graduate School of Banking. I'm excited to be back down there. All my students finished up all their capstone projects for the year, and now they're getting ready to go and present in June so that they can graduate. So definitely getting excited about that, as that is coming up here in just about another month, a little over a month. So definitely I'll be happy to be down hanging out with all my Stonier and ABA peers, which will be a whole lot of fun. So I'll bring more information on that as I have it in over the next month or two. So but anyway, that being said, I want to thank everybody for hanging out with me tonight in the strategy room. I hope everybody has a great weekend out there, and I will see everyone again next week. So take care, everybody.